Hi there, welcome to our conversation on assurance engagements. Before I start, allow me to just give a very quick introduction of what I expect and what you can expect to find in this series of lecture videos about auditing theory. So, actually, this video is what I envision to be the first amongst what I hope to be a series of lecture videos about the concepts of audit and assurance. My goal is to help those students who are about to enroll in auditing theory, or even those students who have already enrolled in auditing theory but might see the need to brush up on the concepts, and even hope to make this one helpful and useful to those who are already reviewing for the CPA licensure examinations. The dream is to make an auditing theory lecture series for all walks of life. With that, allow me to just give you a heads up that our discussion over the course of this conversation will be what you might call a zero-based discussion on auditing theory. So I'm going to pretend that you have no idea yet whatsoever about the concepts of audit and assurance. And if you think that it is something that will work for you, I sure do hope that you will join me as we talk about auditing theory. So I am Christine, by the way, and I shall be your companion or your guide. You can imagine like maybe having coffee with me while we talk about auditing theory. So if you haven't done so yet, please hit the subscribe button and give us a follow at Let's Talk Audit and Assurance. Now, they do say we should start at the very beginning, and the very beginning is where the fundamentals lie, my friends. And because of that, we're going to do a series of GTKYs, or getting to know you. First, we're going to get to know assurance engagements, and later on, get to know auditing. I hope you are as excited as I am, and let's jump right on ahead to the introduction to assurance engagements. Now, have you ever thought about the word assurance? I often ask my students this one. When you hear the word assurance, what comes to mind? And often they will tell me, Miss, assurance is a promise, it's a guarantee. It makes me feel better when somebody assures me of something, right? However, when we go into the technical definition of assurance, especially in the context of auditing theory, assurance is actually a practitioner's satisfaction as to the reliability of an assertion being made by one party for use by another party. In order for us to better appreciate this definition, I'd like for us to focus on the word assertion because it all begins with an assertion. If we were to open a storybook, we're going to say, once upon a time, there was an assertion. But then, what is really an assertion? Well, if you will, you can think of an assertion as a claim, a representation, or even better, think of an assertion as a story. So think about a story being told by, of course, a storyteller to an audience. That is where our appreciation of assurance engagements would hopefully start. Now, if you think about the story is what we will call an assertion. Like I said, it's a claim, it's a representation, it is something that they are saying. And of course, the person who is telling the story, the storyteller in this instance, is the person responsible for the assertion. And the people to whom they are telling the story to, perhaps at one point in time, we have been these people, right? Is what we call the audience, and the audience are the users of the assertion. But have you ever found yourselves in a situation where somebody is trying to sell you something or somebody is trying to convince you of something, and at the back of your mind, you just kind of wish, I wish I have that superpower to know if that what that person is saying is true or not. Right? I think we have all been in that position at one point in time or another. In the context of assurance engagements, ta-da! Enter the practitioner. So the practitioner is an independent person who will express his or her conclusion, his or her satisfaction as to the story that is being told by the storyteller. Now, if you can imagine a practitioner, how do you think will a practitioner be able to express his or her level of satisfaction on the story being told? Then perhaps the practitioner must have evaluated the story somehow, right? So that the practitioner can give a conclusion, then that practitioner must have evaluated the story somehow. And if you are still within that same train of thought as I am, then hang on tight because we are ready now to look at what is the very definition of an assurance engagement as defined by the framework for assurance engagements. So essentially, an assurance engagement simply means one in which a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users other than the storyteller or the responsible party about the outcome of the evaluation or measurement of a subject matter against a criteria. This will also be consistent with the objective of an assurance engagement, which is for a professional accountant to evaluate or measure. In other words, so that the practitioner can express his or her satisfaction on the story being told, the practitioner must evaluate or measure that story, that assertion. And that assertion has to be the responsibility of somebody else, right? It's not the story should not be the responsibility of the practitioner. Otherwise, he would simply be doing a self-checking. So therefore, this story, this assertion must be the responsibility of another person in our illustration that is the responsible party. No, and the practitioner will measure the story against a criteria. Once the story has been evaluated, then the practitioner gives a conclusion. Isn't it beautiful? I don't know, but I've always thought that the idea of an assurance engagement is something quite impressive. And because of this, we should not forget that at the core of any assurance engagement is the expression of a conclusion. So as a practitioner, one must express a conclusion. Now, despite the very interesting facets of the illustration we have just made, we need to go by what really are the elements of an assurance engagement so that we would have a better appreciation and a better grasp of what goes around an assurance engagement. And there are only five elements of an assurance engagement. The first one being that there is a three-party relationship. The second one being that there is an appropriate subject matter. The third one being that there is a suitable criteria. The fourth one is the presence of sufficient and appropriate evidence because remember, as a practitioner, he or she must evaluate the story and in the course of evaluation, then expected to gather evidence, and that there is a written assurance report. Within these five elements, you could already spin the definition of an assurance engagement. So, as long as you know the elements, then you would know what an assurance engagement is. So, let's start with a three-party relationship. From our illustration just a while back, the three-party relationship is very much pronounced. The three-party relationship would refer to the responsible party, or the storyteller, the users of the assertion or the audience, and then, of course, the practitioner. Now, what are the things we need to remember or know about the responsible party? The responsible party may or may not be the contracting party. In other words, the responsible party, the storyteller, may be or may not be the person who will contact the practitioner. So, in fact, at certain points, it may be the users who will contact the practitioner to look at the story that is being told. Now, the responsible party may also be one of the intended users, but remember, the responsible party should not be the only intended user. Let's do a quick segue into your conceptual framework for financial reporting. I'm pretty sure that you must have heard that management is the one responsible for the financial statements. But then again, management is also one of the users of the financial statements. So in this case, management is or maybe part of the intended users, but we would also know that there are so many other users to the financial statements. So while the responsible party may be one of the intended users, but should not be the only one. Now, what do we need to know about the users of the assertion or the audience? Now, the users of the assertion are the persons or class of persons for whom the practitioner prepares the assurance report. And so, for example, if the responsible party is getting a loan from a certain financial institution, and the financial institution would require that the financial statements be audited in this illustration, then the responsible party is management, and the users of the assertion would be the financial institution. Now, a practitioner, on the other hand, is broader than the term auditor because later on we would get to see there are so many other assurance engagements other than audit. Have you ever had, for example, your schools visited by accreditors like PAASCO or PACOCOA or an ISO visit, for example? If you would think about it, actually they are practitioners, but they are not auditors in our technical lingo, right? So a practitioner is broader than the term auditors. Therefore, we will be encountering some assurance engagements which are not necessarily audits. We'll get to that in a few. Okay, so that is our first element. There has to be a three-party relationship. Okay, now the second element is that of a subject matter. And our framework is quite specific. It's not just a subject matter, it has to be an appropriate subject matter. And so we get to ask the question, how do we know that a subject matter is appropriate? Thankfully, the framework has given us a guide. So a subject matter is considered appropriate if you can identify the subject matter and the subject matter may be evaluated or measured. So therefore, it's identifiable, it's measurable against the criteria, and it can be subjected to evidence gathering procedures, or I'd like to call it, it can be testable. So it's identifiable, it's measurable, it's testable. It is necessary for the subject matter to be subjected to evidence gathering procedures because remember, the practitioner has to evaluate the subject matter before the practitioner can give a conclusion. So, how would we know that the subject matter is appropriate? Identifiable, measurable, testable. Now, when we talk about the subject matter as well, we need to differentiate between a subject matter and a subject matter information. Before we go into the technicalities of it all, allow me to just tickle your imagination a bit and ask you. Allow me to go back to the previous slide so we won't have any cheat sheet. So, allow me to ask you if I tell you, for example, the financial statements, and I'm going to ask you, are the financial statements subject matter or subject matter information? And I hope you're thinking right now. What if I tell you your competence? Okay, your competence as, a student. Okay, your competence to go and meet the real world as entrepreneurs and employees. Is that a subject matter or a subject matter information? What if I tell you we're looking at a specifications document about the capacity of our classroom, for example, and we saw there that the classroom can accommodate up to 150 students, okay? Or the capacity of a photocopying machine that it's capable of reproducing 200 copies in, say, for example, a week. And we have seen the manual, we have seen the document. Is that a subject matter or a subject matter information? Lastly, what about we talk about the quality of education that your school provides? The quality of education, is that a subject matter or a subject matter information? Okay, to settle that one once and for all, let's think about the subject matter as the substance, and let's think about the subject matter information as the form. Or another way of looking at it, the subject matter is the substance. The subject matter information refers to the document or the report that contains the measurement of the substance. So, if we go back to the illustrations we have made, if we talk about the financial statements are reports, aren't they? And so, therefore, the financial statements are actually subject matter information. And then we get to ask the question, if that is subject matter information, what is the subject matter? What are the financial statements measuring? What are they evaluating? Actually, the subject matter would be the financial condition, the financial performance, the cash flow management of the entity. So imagine this with me again. If we talk about cash flow management of the entity, that's the subject matter. So the subject matter information or the report will be the statement of cash flows. If you talk about the financial performance of the entity, then that's the subject matter. The subject matter information will be the statement of financial performance or your income statement. If the subject matter is financial position, and you'd like to measure that one. Once the financial position is measured, the measurement will be part of a report or will be reported in the statement of financial position or the balance sheet. So the subject matter is the substance, the subject matter information is the report or the result of the measurement of the subject matter. And so therefore, subject matter and subject matter information, because assurance engagements are broad, it's not just audit, they could also take many forms. For example, perhaps what is closest to our hearts is financial performance or conditions, right? So when we talk about the historical or prospective financial position, performance, cash flows, the subject matter information, of course, will be found in the financial statements. But it can also be for non-financial performance or conditions, such as, for example, the performance of an entity. As reported, for example, in their KPIs, their key indicators of efficiency and effectiveness, or the physical characteristics, like the capacity of a facility, no? Like what we have mentioned a while back, this will be found in a specifications document, or for systems and processes, like an entity's IT system. And you could find the subject matter information with a report or an assertion about how effective it is. Or if you talk about behavior like corporate governance, compliance with regulations, or human resource practices, you might find the subject matter information there in the statement of compliance or a statement of effectiveness. So, as you can see, a subject matter or a subject matter information are closely linked in the sense that the subject matter information is the result of the evaluation of the subject matter. So, in our example a while back, when we talk about your competence to graduate is actually a subject matter. The subject matter information to that would be your report card, it would be your TOR, it would be your diploma, which contains the TOR contains the evaluation or the measurement of your competence. So I hope at this point we're getting out the concepts of the difference between a subject matter and a subject matter information. So again, if we talk about the financial statements as the subject matter information, and the subject matter is the performance position or cash flow management, and the responsible party is the client or entity management. We needed to draw the line or the distinction between subject matter and subject matter information because when we talk about the responsible party, remember the storyteller? The responsible party may actually be responsible for the subject matter information only, meaning to say it's possible that the responsible party is only responsible for the report only. But it is also possible for the responsible party to be responsible for both the subject matter and the subject matter information. So let's imagine a business entity. Haven't we always invoked that management is the one responsible for the financial statements? It's another way of saying management is the one responsible for the subject matter information, right? But we also know that management is the one responsible for the day-to-day operations of the business. The ones responsible for the decision making of the business. They're essentially responsible for the business itself. And so therefore, if you think about it from that context, then management is also responsible for the subject matter. So in that case, management is responsible for both the subject matter and the subject matter information. But can you imagine how different the story will be like if, say, for example, we have company A, and company A is of course the one responsible for its sustainability practices. And then here comes a government organization or a government entity who will measure the sustainability practices of this company and who will come up with a report about the sustainability practices of company A, for example. So if you think about it, the management of company A is responsible for the substance, the sustainability practices of company A, but another entity is making the evaluation. Another entity is crafting the report for the sustainability practices of company A. And so in that case, management of company A is responsible for the subject matter. The government entity who prepared the report, who evaluated, who measured, is the one responsible for the subject matter information only. Right? So I hope you get the gist, no? The difference between a subject matter and a subject matter information. So, like I have said, there are actually five elements. So, let's now move on to the third element, and that is about a suitable criteria. Again, notice the framework is quite specific, not just any criteria, it has to be suitable criteria. But what are criteria anyway? So, criteria are the benchmarks used to evaluate or measure the subject matter, including, where relevant, benchmarks for presentation and disclosure. I often illustrate this one to my students by asking them, have you ever seen, for example, a beauty pageant? Let's just say, for example, Miss Universe. Because if you ever watched a beauty pageant, then you would know that there are criteria for judging, right? So, criteria are the benchmarks that you use to evaluate the candidates, for example, to come up with the epitome of beauty and grace in the universe, right? So, criteria, these are the benchmarks used. This is where we match the story against. So, for example, if the management, no, if your client, if management is telling you that this is cash, okay, and we are reporting cash at face value, that's the assertion, that's the story. As a practitioner, you would need to evaluate that story versus a criteria. So, if I'm going to ask you now, if the story is about accounting for cash, the presentation of cash, the valuation of cash, which one do you think will be your criteria? What will you measure it against? And perhaps some of you would think, oh, miss, we will measure it against the accounting standards, right? What do the accounting standards say about how to present cash, how to value cash, how to measure cash? And so, if you're in the same train of thought as I am, then we're on the right path. When we talk about the criteria, it's the benchmark. No? In our case, we normally refer to it as the standards. However, we must also acknowledge that criteria can either be formal or less formal. So we talk about formal criteria, they are linked towards what we call established criteria, and these are those embodied in the laws or regulations or issued by authorized or recognized bodies or experts that follow a transparent due process. So when you talk about your accounting standards, your PFRSs, your IFRSs, these are considered as established criteria. When you talk about laws, these are established criteria. But then there is also what we call less formal criteria or specifically developed criteria. And these are criteria developed especially for the purpose of the engagement. Have you ever had, say, for example, a meeting with your teacher and the teacher discussed the house rules, and then you would notice that the house rules will only be applicable for your class but not necessarily for your other classes? So think of specifically developed criteria as something similar to that. So in the context of businesses, when you talk about key performance indicators, for example, what is their quota, for example, right? These are all only applicable for that business. It cannot be prescribed to other businesses as well. And so in that case, it's a specifically developed criteria. Okay, now, because we are saying that the criteria must be suitable, we have to know what are the characteristics of a suitable criteria. I have initially made a mnemonic of CNUR squared, but then my students have, a more creative way of remembering the characteristics, and they would rather remember it by RUNCR. So the mnemonic RUNCR. But what makes a suitable criteria? Well, it has to be complete, of course. It has to be neutral, free from bias. It has to be understandable. It has to be reliable, meaning to say, when you look at the source, it's something or a body or a person that you could rely on. And it must be relevant. When we say relevant, it allows you to make decisions. It is helpful in your decision making. You consider that one when you decide. So these are the characteristics of a suitable criteria. Take note as well that criteria must be communicated. Just like, for example, in your case, I'm pretty sure when you started your classes, your teachers must have told you what the grading system is. And haven't you now realized that the grading system reflects the criteria being used in class to measure your performance? So the grading system is being made known to you, and rightly so, right? So criteria must also be made known. How do we make criteria known? Well, in the case of established criteria, this can be made known publicly. You can see it in the websites, no, of the standard setting bodies. These are publicly available. Another is the criteria might be made known, they may be identified in the report, either in the subject matter information or in the assurance report. For example, I think you have seen, or I hope you have, if you haven't yet, I invite you to try and take a look at a sample auditor's report. And you would see there that the auditor would use terminology such as, we have audited the financial statements of XYZ company as of and for the years ended, blah, 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 in accordance with Philippine financial reporting standards. So you would notice in the assurance engagement, in the assurance report rather, the criteria is already being identified or mentioned. And this could also happen in the subject matter information itself. No? And some criteria, they are also made known by common sense. What do I mean by this? For example, I'm pretty sure you all know how many seconds there are to a minute, right? How many? Where there are 60 seconds to a minute, there are 60 minutes to an hour. There are, well, 28 days in February, except when it's a leap year, and then there'd be 29 days. So there are certain standards or criteria that, well, we just know by common sense, okay, or public knowledge. Okay. Now, the fourth element is the sufficient and appropriate evidence. Now, actually, this is the element that is quite heavy and hefty. It has a lot of concepts that would go into it when we talk about sufficiency and appropriateness of evidence. And these are the things that we must consider. So, the very context or the very idea of professional skepticism, we'll introduce it here. Sufficiency and appropriateness of evidence, cost benefit considerations, materiality, assurance engagement risk, and of course, quantity and quality of available evidence. Like I said, this is quite lengthy, so if in case you feel a little bit overwhelmed, just feel free to hit the pause button, maybe take a sip of water, head out to the restroom, or just stretch out and then come back. So let's start with professional skepticism. Professional skepticism is an attitude, okay, of a that involves a critical mindset. We always say perform the engagement with an attitude of professional skepticism. It means use a critical assessment, a questioning mind. That's a favorite phrase we use for professional skepticism, a questioning mind of the validity of evidence obtained. And it also means being alert to evidence that contradicts or brings into question the reliability of documents or representations by the responsible party. For example, perhaps you have tried entering a class and maybe reading some materials in advance, reading some, study guides or study materials or even standards, the standards in advance, and then going into the classroom and then listening to your teacher and then noticing that what the teacher is saying is somehow different from what the books that you have read have said. Oh, it rhymed. From what the books you have read have said. And then perhaps throughout the discussion of the teacher, you might see the need to like raise your hand and then clarify. That is, in essence, an application of professional skepticism. You are alert to evidence that contradicts or brings into question the reliability of the story. This is also where our being observant would come in, especially when we perform assurance engagements, especially when we perform audits, and we get to notice that there are some things that just don't tie up. That feeling, of, hey, this doesn't tie up, it's being alert to evidence that contradicts or brings into question. And it's an application of professional skepticism. Two things, remember, questioning mind and being alert to evidence that contradicts. So whenever our clients would tell us something, we shouldn't take it at face value. No, we shouldn't always take it at face value. There is always a need for us to evaluate, to probe further, to investigate. That's the context of professional skepticism. And in audit, we are reminded that we must always conduct the audit with a questioning mind. Similar actually with assurance engagements. Now, this idea of professional skepticism is being reinforced by the concept of information risk. I could tell you about the technical definition of information risk, but I think when I tell you these two words, then it would already click. And the two words are fake news. Have you ever been a victim of fake news? Or do you know somebody who has been victimized by fake news? Do you know that fake news is actually information risk? Information risk is the risk that the information that we consume, the information that we receive, the information that we utilize may not be accurate or may not be truthful, or it may contain misstatements. So that is information risk. In a world where a lot of people are asking us to trust them, no, then in a world as well where fake news is proliferating, information risk is at its ultimate high, and because of that, we should always be professionally skeptic, especially in the conduct of assurance engagements. Now, another thing that we would need to consider in terms of sufficiency and appropriateness of evidence is, of course, the term sufficiency and the term appropriateness. So, in its most simple context, when we talk about sufficiency, we're referring to the quantity. Is it enough? Do we have enough? Okay. And the greater the risk, the higher the quantity of evidence we would like to gather. I think for most accountancy students, you could resonate with this one. Like, have you ever wondered why your schools are so strict on you when it comes to retention policies? Why there has got to be departmental exams, qualifying examinations, no? And then for some integrated accounting classes, why must there be cut-off grades, right? Well, if you reflect on it, then that must mean that the institutions view you as high risk. And you must be high risk because there is a board examination you need to take. And in the Philippines, the CPA board exams are one of the most difficult, if not the most difficult board exams. So the risk is very high. And because the risk is very high, the more evidence your schools would like to gather about your readiness to take the examinations. So the greater the risk, the more evidence would be needed. If you talk about the quantity as well, you would notice that the quantity is actually also affected by the quality of the evidence being gathered, in the sense that the better the quality of the evidence you have, the less you need, right? It's just like, for example, somebody telling you there will be no classes tomorrow, and then you would ask your friend, who told you that? Oh, I just heard that from a friend who heard it from a friend who also heard it from a friend. And so you would endeavor to gather so much more evidence just to, prove that the story that you got was correct. But if you heard it directly, for example, from the university president, you bumped into the university president in the canteen, and then the university president told you, ah, yes, classes will be suspended tomorrow. And so if somebody would ask you, where did you get that from? And then you would say, well, from the university president. And no need to ask anymore, right? Because the greater the quality, the lesser the quantity you would need. Now, speaking of quality as well, quality actually refers to the appropriateness. And this is what I said. The better the quality, the lesser evidence is needed. And the quality of evidence is affected by both relevance and reliability. Now, when we talk about relevance, how would you know that something is relevant to you? For example, if I tell you right now that, let's just say, for example, the cutoff grade, no, for the College of Nursing in your schools will be increased to 1.5, 1 being the highest. The cutoff grade for the College of Nursing will now be 1.5. Is that something you would most likely use? Is that something that you would consider? Is it something that would put you in panic mode? Or is it just something you would say, okay, good to know? Now, if you're a BSA student, you most likely would not be interested in the cutoff grades of the College of Nursing, right? And so in that case, that information is not relevant. But what if I tell you that the Professional Regulation Commission has just released an announcement that the testing sites for the licensure examinations will now only be just Baguio, NCR, Cebu, and Davao. And that's true, by the way. No. So as of time of recording, those are the only four testing sites for the CPA licensure exams here in the Philippines. Perhaps that would be something that you would consider, right? If you're residing somewhere not in those testing sites, it's something you would need to consider when you decide, for example, where to take the exams. Would you need to fly in there? Would you need to, like, rent a boarding house, or what have you. So therefore, an information is considered relevant if you factor it in your decision making, if it's something that you consider when you make a decision. But when you talk about reliability, reliability refers to the source. Who said that, right? That's reliability. It refers to the source. And so with this, the standards have actually come up with what they call the hierarchy of evidence reliability. It sounds so sophisticated, but mind you, when you see these things, you would realize it's all really just common sense. For example, externally generated documents, or external documents are of course always considered more reliable than internal documents, provided of course that the source is the right authority, right? Because it might be an external document, but the one who gave you does not have the authority, so it will still not be reliable. So external documents versus internal documents, external is more reliable. In case of internal documents, because we have to admit there are some documents we don't have a choice, it's really just all internally generated. So for internally generated documents, well, those generated under a good system or a strong system of internal controls are of course more reliable than those generated from a weak system of internal controls. That's a given, right? Evidence that is obtained by the practitioner directly versus that which the practitioner obtains simply by inference, simply as a product of inquiry, no, then of course the direct evidence is more reliable. Or documentary versus verbal or oral evidence, of course documentary is more reliable. Or the original versus photocopies or fax copies, of course the original is more reliable. But the point here is that when you talk about reliability, you talk about the source of the evidence. Okay? Now, we also remember that there are well cost benefit considerations that need to be made when you gather evidence. But we are reminded that while cost is a consideration, it is a consideration, but the matter of difficulty or expense involved is not in itself a valid basis for omitting an evidence gathering procedure for which there is no alternative. In other words, yes, we consider the cost, but we cannot make it a reason. We cannot make it an excuse for not performing a procedure for which there is no alternative. Okay, if we have no choice, if that's the only procedure that could help us evaluate that assertion, that story, even if it's difficult, even if it's expensive, assuming there are no alternative ways, that's the only way, then we got to do it. Okay, so cost is a consideration, but the cost or the difficulty in itself is not a valid basis to forego a procedure when there is no alternative available. Okay. And then, of course, we get to talk about materiality. And I'm pretty sure in your financial accounting and reporting subjects, intermediate accounting subjects, you have delved into the concept of materiality. In audit, actually, and in assurance engagement, materiality is also an important concept, but we'll have a separate discussion for this one later. It deserves its own spotlight. But at this point, we just remember that materiality is determined by a practitioner's professional judgment. And actually, materiality has an impact on your assurance effort or your audit effort. It also has an impact on the quantity of the evidence that you would gather. So if you imagine, for example, we have two options: set materiality at 1,000 versus set materiality at 1 million. If you imagine what it means, if you set materiality at 1,000, that means for as long as you get to see misstatements of 1,000 and management does not correct the 1,000 misstatement, then you would already consider the financial statements to be materially misstated. But if you have set the materiality level at 1 million, even if you see a misstatement of 1,000, you're still fine. You see a misstatement of 100,000, you're still fine. You see a misstatement of 800,000, I'm still okay, right? So if you compare the two practitioners, the one who has set the materiality at 1,000 versus the one who has set the materiality at 1 million, the practitioner who is setting materiality at a lower amount, in this case 1,000, is actually becoming stricter. That means the practitioner must have assessed the engagement to be of a higher risk, or it must be riskier. And we know that the higher the risk, the more evidence must be obtained. And so, therefore, if materiality is set at a low amount, that means you are strict, and that means you must gather more evidence as compared to the practitioner who has set materiality at 1 million, right? So, it would still take a lot of misstatements before that practitioner will go into panic mode. So, therefore, materiality also affects the sufficiency and the appropriateness of the evidence that we are gathering. Okay. Another thing that we must consider in sufficiency and appropriateness of evidence is assurance engagement risk, because, like what we have said, the risk would affect the evidence that you would gather. And assurance engagement risk is mainly the risk that the auditor gives an inappropriate conclusion on a, or the practitioner gives an inappropriate conclusion on a subject matter. So, in other words, nasayop ang practitioner. Nagkamali yung practitioner. The practitioner made a mistake. So, gave an incorrect conclusion. So, assurance engagement risk, like what we have said, no, is the possibility of an inappropriate conclusion. And later on, especially when we talk about audits, you would realize why that possibility is always present. For as long as there is an assurance engagement, there will always be the possibility of an inappropriate conclusion on the subject matter. That being said, as well, we got to appreciate that the more extensive your evidence gathering procedures are, the lower are the chances of an inappropriate conclusion, right? I think it's a given. The more evidence you gather, the lesser is the possibility that you will give an incorrect conclusion. Okay, now thinking about the assurance engagement risk, we also need to look at the components of assurance engagement risk. And these are the components of assurance engagement risk. We have inherent risk, we have control risk, and then we have what we call detection risk. So if you would notice, we have categorized inherent risk and control risk together because these are risks which we deem to be uncontrollable by the practitioner. In other words, it is something that the practitioner cannot control. It exists outside of the assurance engagement. Another way of looking at it will be with or without the assurance engagement, these two risks will be present. In fact, they are, I would call them best buddies, no? They are BFFs. And collectively, we call them the risk of material misstatement. So inherent risk and control risk together make up what we call the risk of material misstatement. Now, what do we mean by inherent risk? Actually, from the term itself, inherent, it's the susceptibility of a subject matter information to a material misstatement, assuming no related controls exist. We are going to assume that there are no internal controls, and we're going to look at how vulnerable is that subject matter information to a misstatement. Okay, my usual example that I would give to class for this one is, can you imagine if I put in the middle of the school quadrangle, or let's just say the middle of the school lobby, two tables. And on one table, we have a mountain full of cash, all in 1,000 peso bill, a mountain full of 1,000 peso bills. And on the other table, I have a mountain full of colorful paper clips. Okay, and since we're going to assume that there are no controls, I'm going to send all of the security guards home. I'm going to disable all of the CCTV cameras, and I'm going to leave all of the gates unlocked. They are open for anyone to come in. Now, assuming there's going to be a burglar or a thief who would walk inside the school and would chance upon the lobby, assuming there are no controls in place, which one do you think would the burglar most likely get or most likely steal? I would presume your answer would be cash, right? So cash is inherently risky. The more liquid an asset is, the higher is its inherent risk, assuming no controls in place. Another would be if you would perhaps be asked which one would you most likely, or which one is most possibly be, a source of misstatement. Is it accounting for prepaid insurance or accounting for leases? And at this point, you would think about lease accounting, and you would think about all of the complexities of accounting for leases, and it would send shivers down your spine. And then you would say, Miss, we would most likely make a mistake in accounting for leases rather than simply accounting for prepaid insurance. So looking at the complexity of the item, looking at the complexity of the subject matter and the subject matter information, you would get to see that inherent risk is higher for one compared to the other, again, assuming no related controls in place. Or if I was going to tell you, consider two instances, one which would require estimates to be made and one which can be determined objectively. Which one do you think would, you know, would probably have a higher chance of a misstatement? And then of course we would say, well, the one wherein estimates would be needed, right? Because estimates are matters of judgment. Sometimes they have some discretionary, they require some sense, some sort of discretion, and so then therefore it is more inherently risky than the one which can be objectively determined. And so in this case you would get to see inherent risk is that susceptibility, assuming, please take note, assuming no related controls exist. We need to point out that assumption. Why? Because when we take a look at control risk is where we assume that there are already controls, but then the controls may not be able to prevent or detect or correct the misstatements. This is embodied in the line, there is no perfect system of internal controls. Even if you get the most sophisticated, the most expensive internal control systems, there is no perfect system of internal control. And I normally illustrate this to my class by asking them, have you ever walked inside the school campus but then actually you were not wearing your ID, or you forgot your ID, or worse, you used somebody else's ID? And then most often than not, a majority of them would say, yes, miss, we have. That is the very concept of control risk. There are controls in place, but there is no perfect system of internal controls. Now, there will always be deviations to that. And later on, when we discuss internal controls, you would get to understand why. No, why are there always instances, or why is it always possible that controls will not be able to prevent or detect or correct misstatements? Now, as what we have mentioned, inherent risk and control risk are uncontrollable by the practitioner. There's nothing the practitioner can do. This is really how it is. It is what it is. However, the good news is there is one component of assurance engagement risk that we can control, and that by we, I mean the practitioner, and that is detection risk. Detection risk is the risk that the practitioner will not be able to detect a material misstatement that exists. And how do we control detection risk? Well, you guessed it right. It will be controlled via the evidence that we will obtain. This is where we inject the concept of nature, timing, and extent of your evidence gathering procedure. So, walk with me through this illustration. So, let's just say, for example, you were able to identify that you were able to assess, that's the correct term, you were able to assess inherent risk and control risk to be high, but you still accepted the engagement. There were so many red flags, but you still decided to accept the engagement. Now, because you have accepted an engagement that is high risk, then as a practitioner, you would say, well, my acceptable level of detection risk, I repeat that, my acceptable level of detection risk will be low. In other words, yes, I am accepting this engagement. The engagement is high risk, and because of that, I will be very strict. And by very strict, that means my acceptable level of the possibility that I will not be able to detect a misstatement, aka acceptable level of detection risk, will be low. If your acceptable level of detection risk is low, that means you are strict. And if you are strict, then you will choose evidence gathering procedures, the nature of which would be more effective than less effective. What do I mean by this? Looking at the nature of the evidence gathering procedures. Suppose you have a choice between simply asking the cashier for a certification versus, versus conducting an actual cash count. If you are a very strict auditor, which one would you choose? Just asking the cashier for a certification or actually doing a cash count? I would suppose you would say actually doing a cash count, right? So that's the nature of the evidence. Next, timing. When you talk about timing and the practitioner is very strict, the practitioner will endeavor to cover the entire period under audit, no, in the testing, and would do the testing as close to the balance sheet date as possible. Whereas if the practitioner or the auditor is not so strict, kung chill lang, if the practitioner is simply, on chill mode, then the practitioner will most likely do interim testing only. Okay, but the stricter you become, the more you wish to test the entire period or test as close to balance sheet data as possible. In terms of the extent would normally refer to the sample size that you would use. So think about this one. If you are a strict auditor, if you're a strict practitioner, would you go for a smaller sample size or a larger sample size? I think you would tell me the stricter you are, the more evidence you would like to gather, and so therefore the larger the sample size you would use, right? So that is how a practitioner, that is how an auditor responds or controls detection risk. It's by looking at it from the viewpoint of an acceptable detection risk. And the lower your acceptable level of detection risk is, the more evidence you would have to gather. Okay, and this is how it affects evidence gathering procedures. Okay, so that's assurance engagement risk, a very important concept actually of assurance engagements. And then, of course, we get to talk about the nature of the evidence. And the nature of the evidence is that it is ordinarily persuasive rather than conclusive. We get to be reminded that as practitioners, it is not part of our responsibility to authenticate the documents. That's beyond the scope of our expertise. No? So the evidence that we will be gathering will simply persuade us that the story is correct. It will persuade us that what the storyteller is saying is true, but we cannot give a conclusive conclusion, a conclusive yes, no, a conclusive opinion. Because at the end of the day, we do not authenticate documents. It's beyond our scope of expertise. And say, for example, if you take a look at a check and it was signed, and you get to see that, yeah, the signature looks legit, but we are not experts at looking at forged signatures. So the most that the check and the signature can do is to persuade us, no, that it is correct, but it is not conclusive. So that is the nature of the evidence. And since I said there will be five elements to an assurance engagement, so this is now the fifth element. I hope you're still okay. I hope you're still enjoying our conversation so far. But the fifth element is there's got to be a written assurance report. By that, I think needless to say, it must be written, right? Because it's a written assurance report. And the written assurance report may come in the form of hard copies, or it may come in the form of printed copies or even electronic copies. They are already considered as written assurance report. The written assurance report must be in the form appropriate for either a reasonable assurance engagement or a limited assurance engagement. And you're going to go like, uh-oh, what's a reasonable assurance engagement or what's a limited assurance engagement? So let's take a look at what the standards have to say. If you take a look at reasonable assurance engagement, this is the high level. Remember, we can only give reasonable assurance, never absolute assurance. Okay, we're going to answer why when we introduce audit later. So make sure to stay tuned for that video as well. But the high level of assurance that a practitioner provides is called a reasonable assurance. A reasonable assurance engagement has as its objective the reduction in assurance engagement risk to an acceptably low level in the circumstances of the engagement. And I'd like to compare that with the limited assurance engagement, which is the moderate level of assurance, that says it is the same. What is the objective? It's the same as in reasonable assurance, but the risk is greater. Okay, and again, I often tell my class I'm so frustrated with how the standards are basically defining these things. It's a short turn off to the students. So let's take a look at the very heart of reasonable and limited assurance. What's really the difference between the two? I'd like to draw your attention to the conclusion that is being given by the practitioner in these assurance engagements. In the case of reasonable assurance engagement, the practitioner's conclusion is positive. But a limited assurance engagement, the practitioner's conclusion is negative. What does that mean? Again, let's give an illustration. This is how a positive conclusion sounds like. In our opinion, internal controls are effective in all material respects based on XYZ criteria. And this is how a negative assurance sounds like. Based on our work described in this report, nothing has come to our attention that causes us to believe that internal controls is not effective in all material respects based on XYZ criteria. What have you noticed? The negatively worded conclusion is a bit more wordy than a positively worded conclusion. And have you not noticed that in your case, for example, in your day-to-day interactions, when you are sure about something, when you are more confident about something, you're usually straight to the point, right? Like, hey, what's the answer to number five? Ah, it's letter A. But if you're not sure, then you might say, I'm not really sure. I haven't really studied that area, but somehow I feel like maybe letter A is the answer because it doesn't seem like it's B. And also I heard, but I'm not sure. So have you noticed how this interaction, how this dynamics actually happens in your day-to-day school life? The more confident you are, the more straightforward is your response. The less confident you are, the more you try to beat around the bush. And this is actually true as well for positive and negative conclusions. In a positive conclusion, you are very confident in saying, in my opinion, internal controls are effective. Even when you say, in my opinion, internal controls are not effective, even when you say they are not effective, but when you say it that way, straight to the point, that's a positive conclusion. As compared to a negative conclusion, well, based on the work that I have performed, I have not seen anything that would make me think that it's not effective, therefore it must be effective. So it's beating around the bush. So what's the reason? Why is the positive conclusion more confident as compared to the negative conclusion? Sorry. Well, the answer to that is mainly because of the scope of the work being performed. The scope of the work, SCOPE, the scope of the work. An example of a positive conclusion that is found in a reasonable assurance engagement is that of an audit. So, an audit is a reasonable assurance engagement, high level, positive conclusion. Do you know that the auditor has access to any and all audit procedures that the auditor would wish to perform? The auditor wants to do a cash count, physical inventory count observation, wants to ask, wants to observe, wants to check documents. The auditor can do any and all of those things. That's the beauty of the scope of the auditor's work. It's unrestricted in scope. But if you talk about a perfect example of a limited assurance engagement, which has a negative conclusion, is that of a review. What does a review engagement, entail? Well, for a review engagement, the practitioner can only do two procedures. That's inquiry and analytical procedures. Simply to ask and then to compute. That's it. Okay, so if you notice between an auditor and a reviewer, between a one who does an audit versus a one who does a review, then the one who does an audit should be more confident because the auditor has a wide array of procedures that can be performed or that he or she can perform. But a reviewer, in the case of review engagement, can only do inquiry and analytical procedures. Therefore, feels a little less confident. And the lesser confidence, the more wordy the conclusion is. That's why the conclusion for limited assurance engagements is negative. All right. So, yay, congratulations to us. We were able to finish the five elements of an assurance engagements. Give yourselves a pat in the back. And while we are not yet finished with the introduction, actually, but since this has become quite a lengthy video, so we will continue in our next discussion. What are the different types of assurance engagements? So, I hope that we continue our conversation. So, see you in the next video.